Let's get more on the markets from Lyle Stein, president at Forvest Global Wealth Management. Lyle, thanks for giving us the time this morning. It seems perilous to say anything about the markets right now, whether they're up or down, because it changes so rapidly. But what has caught your interest this morning?
Well, there's no question about the uncertainty out there in the market, Andy. Markets don't like the fact that they really can't make what I would call a bet on the future, given the tariff uncertainty. Now, that's creeping into all kinds of other things, such as how do you actually even look at a company in this highly uncertain world? And so, you have a day where we were down 4% at the open, and then this rumor comes out, and then we run off, and now we're kind of balanced. One might say it's oversold, but without any sense of where the world is going, it's hard to make a strong case it's going up, it's bottoming, or it's going to continue down.
Lyle, one argument you would make was that even prior to this tariff-induced sell-off, stocks, I think especially you mean in the US, were at pretty high multiples of earnings. But now even those earnings have come under question.
Well, and that's the big unknown. So, one of the things we do every week is look at FactSet data. It comes out every week in terms of US S&P 500 earnings. And the surprising thing is, yes, they're down, but they're not down, in our view, nearly enough, given the economic uncertainty, given the significant slowdown in the US economy, and then given the fact that margins are at all-time highs. And so until we start to see analysts dropping their numbers, and that'll start happening really in the next couple of weeks with the Q1 earnings reports, it's hard, again, to make a positive sense on how to properly value this market. And so now it's in the hands of traders. And, today's action is just an example of that trading activity that's caused by hedge funds and more day traders than investors.
Let's put up maybe a 1 week for the TSX Banks Index or the Financial Index. You may have seen National Bank analyst Gabriel Dechaine cutting his earnings estimates for the banks. And I mean, earnings estimates across the board in all industries are probably going to be coming down.
Well, yeah, that's right. And, the thing is, the banks are very levered to the Canadian economy. And so the bet that investors are making when owning Canadian banks is that our economy will continue. The growth, albeit slow, will allow these dividends to increase. And that's really why people own bank shares. But again, in this time, it's hard for us to see Canada outperforming as an economy, given our, tight nature to being linked to the U.S.
I mean, I'm always bringing this up. The viewers are probably sick of it, but would you be attracted by a TD Bank right now? Yield well north of 5%. And of course, they'd be extremely low to cut it. I mean, they've a really strong balance sheet for one thing.
That's an issue. We wouldn't be a buyer of Canadian banks, much more looking towards the U.S. banks than the Canadian banks, because we are in Canada, a very unique real estate situation. And so domestic banks, and granted TD is less domestic than some of the others, still give us cause for pause in terms of making an investment in the area. There's a 5% yield there, and that's good. But there's other places as well where we can get 5, 6, 7% yields. And we think those are better than buying a Canadian bank stock.
Where would you look for yields like that, Lyle? What industries or companies?
Well, we've talked about this before, Andy. We like the pipeline area. Okay. We like the fact that we're getting well north of 5% yields. And we like the fact that it is a North American situation more so than a made in Canada situation. Really intrigued to date by the Canadian energy stocks. I mean, they've gotten absolutely slammed. And, the price of oil, as you mentioned before, is hitting $60. But these companies are really in good shape. And the beauty is at $60 oil, ultimately, the price is self-correcting. So it's an area, and by the way, the companies have hedged, so it's a good place to look for income. There's lots of places to look for income when everything goes on sale. And so what we're looking at now is how to upgrade our portfolio. Take cash that we do have and reinvest it now, not at 4% yields, but 5 or 5.5% yields. Just not looking at TD.
Oh, okay. What about tech? Let's have a look at a 1 week chart for the NASDAQ 100. Are any of those big US tech names appealing to you right now, Lyle?
We don't have a lot of tech in our portfolios. Part of the reason that the market has been so strong, it was a one-way trade. ETFs, technology ETFs in particular, saw all kinds of cash flowing in. And as a result of that, the narrowing of the funnel into the names such as the Magnificent Seven took these stocks up to quite high multiples. They've come in, but they could come in a lot more on a liquidity basis. As investors continue to be concerned about what's going on, any doubt to the economy, they sell. And you tend to sell the ETFs, and the ETFs are all heavily concentrated in those Magnificent Seven names.
That's been a thing we've heard warnings about, haven't we? That so much money went into the ETFs, the market weight, the index weighted ETFs, and that pushed up the tech stocks, and the people got jubilant about that, and they bought more ETFs. But I guess things like that work in reverse on the downside.
Well, exactly. And that's why we really view this as a great opportunity to stock pick, that it isn't just playing a trend, playing a liquidity wave, playing the momentum wave. You know, we're more fundamentally driven. And so this is a market that's coming back to fundamentally driven investors like ourselves. This is actually a great opportunity to buy things that went on sale because they got blown out of an ETF as the ETF had to sell down to basically buy stocks. So value, I think, is coming back into the market, though not immediately and not on these days when everything is down 2-3%, whether it's NASDAQ, Dow, the Russell 2000. On days like that, it's a great chance to just keep your powder dry and look and think.
Lyle, am I right in thinking that you're weighting in gold and gold stocks is close to 20% now?
That's about right. Plus or minus. I mean, depending, we manage segregated accounts for our clients at Forvest, but that's the general weighting. We have had a very a positive view on gold as a asset class that we call protection against calamity. Calamity, from an investor perspective, comes in two ways. It comes in the way of inflation, which is the long-run death of investing, and it comes in the way of geopolitical uncertainties that we've had for a long time, since Trump's talk about tariff. Uncertainty is reigned, and that's very positive for the gold market. Whether you own gold shares, gold bullion, gold royalty companies, they've all been relative winners, and that really came through with our portfolios in the first quarter.
We better leave it there, Lyle. Thank you so much for joining us today.
Good talking to you, Andy. Take care.
Lyle.